All right, everybody, welcome back to Cashflow Chronicles. It is January 16th, 2024. We are back with Kris Patel. Thankfully, he survived, and we are just happy that he's here and we get to hang out. Appreciate everyone's patience as we took a little bit of a hiatus, but we are happy to be back and happy to be alive. Kris, anything before I hit the intro?
Yo, get your flu shot. This year is notoriously bad. Like, I did not get my flu shot, and so I caught it, and it's been rough. It's been rough, but I'm better. You know, it's just I still have the after effects. I'm still coughing up a lot of green shit. So that's just a part of getting sick sometimes, you know. So yeah.
Cashflow Chronicles approved. Get your flu shot. Be back after this message.
The stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good. Huge upside potential, upwards of $60,000.
That gets me every time. It's so funny.
We have to work on it, bro. We have to work on it. I don't feel... For some reason, it still feels a little weird. You know,
it's weird. No, it did sound a little bit better when you had kind of the LL Cool J thing kind of like playing throughout the background. But then when we got copyrighted that one stream, and so I was like, well, shit, you can't be playing it the whole background. So now it's like cutting in and out. But we need to, at some point, we'll get it figured out and perfect.
We might have to reach out to Carlos. Carlos did a pretty good job for us for Finance Junkies. So,
you guys get an intro?
Yeah, we got multiple intros actually.
You just don't use it, or?
I think we've used it once or twice. It's very new. We only started like not too long ago.
So, okay, I generally tune in probably like 5 or 10 minutes after you guys already kicked off, so I haven't seen it as of yet, but cool, man. Well, I have a quick question. I was literally the only person at the office today. Everyone else stayed home because we're apparently having historic freezing down here in Houston, which is anything below 32 degrees. So I was literally the only person that made it in the office except for some of the security guards. And so I was just blasting a lot of the DAVOS interviews that were going on with Andrew Ross Sorkin and Becky Quick, and a lot of good interviews. But I was curious, did you hear anyone in particular that you wanted to pull up and talk about, or is there anything from Davos that you've seen thus far that you wanted to highlight?
You know, not necessarily just yet. I was looking for commentary around like this Red Sea Houthi thing, but I haven't seen as much of it. So yeah, I'm keeping my eye on that, and possibly getting some commentary on what people are pretty much looking at for 2024, you know, as in terms of like different areas of investment and everything else. So, you know, the theme that I keep hearing about is, of course, AI. So, you know, the year of AI continues. The one thing I will say is a lot of companies now are actually talking about doing a lot of workforce reduction measures. And one of the principal reasons why is because of AI. So I think there could be some opportunity in this market where, sorry.
Hold strong, Kris. Hold strong.
Yeah. Where there's still a lot of room for workforce reductions, which means that a lot of those savings could end up going back into the bottom line. So that could help support a lot of companies. So I think that's one thing that I'm taking a look at. Another thing is just like overall how the consumer is dealing with, one, the ramifications of the inflation being persistent, you know, and also how is that going to affect us politically? Because I think that half of economics is politics. So if you kind of like, you have to marry the two sometimes. So, you know, it's very interesting to see what the dynamic is. But right now, I'd say, you know, I'm not enthusiastic about putting my money to work right now. I mean, the money that I have already in the market, I'm letting it do its thing. But I am building a cash position because I do think that there are some opportunities that are going to be coming our way. in a very short order. So I think the best thing to do is just have some dry powder ready, so that this way, when an opportunity does come, you can, take some meaningful steps and enjoy the returns from that.
For sure, agreed. I wanted to give a quick shout out to Lars. Thank you for the $5 super chat, much appreciated, my friend. I do agree with you wholly, Chris. I mean, I think I've heard a lot of chatter and verbiage around people switching to saying, okay, March is, I was going to say Mars. March isn't when we are really anticipating some of these rate cuts, and we're really thinking that they're going to be either in the middle of the year, towards the end of the year. We think there's only going to be 3 to 4. So I think people are backing away from that 6 to 7 rate cuts for the year. But I don't think that the market has adjusted to that yet. Like, we're still at a pretty, I mean, we're still within a couple percentage points of all-time highs. So it's like, to me, I still think that there's an opportunity to come down, and whether that's waiting till the end of the month when we have that July 30th, July 31st FOMC meeting and hearing the verbiage from them in particular is beyond me. But I still think that there just needs to be some air that needs to come out of the market before we take that next leg up higher. And I did want to share, because you mentioned specifically these layoffs, and I think that this is, they're not little small. Some of them are small, some of them are actually rather big. So Google's laying off 1,000 employees. Amazon, specifically around the Audible, is laying about 5% off of its total staff. They're also laying off in Twitch, which I thought was interesting, because that's probably, although streaming has kind of come back a little bit, I was surprised, because they're trying to have that streaming aspect of things. So maybe they're focusing more on the Amazon Prime side rather than, say, the Twitch side, which maybe makes sense. Even BlackRock, I was surprised to see layoffs from. Let me just double check that I'm sharing. Okay, I'm sharing. Unity Software, which I know some of you guys are big into as well. And then you have some bigger ones as well, like NewScale is laying off nearly 40% of their workforce. So some really big numbers kind of coming out at this point. So Yellow is a trucking company, that's 30,000, UBS 35,000, Maersk 10,000, Meta 10,000, Microsoft. So a lot of impacts coming through from the layoff standpoint. And I guess I'm kind of curious, is like, do we think that this is going to continue? Do we think that this is really, I don't really see this as a necessity. I think this is, like you said, more of a polishing. And I think that this is really an opportunity for them to do their last minute polishing until they start to maybe go back into focused reinvestment. And I hear that verbiage a lot from people about making sure that they're simplifying their organizations, that they're focusing on where particularly they should spend their capital. And I think that they took an opportunity to reduce CapEx a lot in going in from 2021 to 2022. But I still think that this is their last second polishing before I think that they see that we're going to start going into the 2025, 2026 timeframe, where they're probably going to be doing a lot of further investment into the future. So that's just my interpretation. I was just curious what your thoughts are.
I mean, to me, the way I'm interpreting this is, you had a lot of hiring. You had like almost over hiring during the post-pandemic years. So a lot of companies are just right-sizing the ship. They realize that they don't need as many people. So they're really taking a hard look at where they can do some cost containment. And also means that maybe their top line revenues may not be doing exceptionally more than what they were in the past. So in order to kind of mitigate that, it's good to just trim areas where you don't need a lot of people. And, when it comes to AI, people are really underselling in terms of deflation going forward. Because I was talking to someone about this not too long ago, and they work for a company that deals with Epic Systems, which is a EMR provider. And one of the things he was telling me about is how, he used to have a team of like 3 people, and they basically laid off 2 of them, and it's just him. But the work is getting done because now he uses GitHub Copilot for everything. Like anytime he needs to do a lot of this coding and all this other stuff, now it's just prompt, get the code, test it out, make sure it's good, and boom, deploy. It's like a much quicker process than what it was. So, you know, a lot of people before where you needed like actual do this, a lot of those processes are getting eliminated. So what you're seeing is you're seeing the development of a highly skilled workforce that does a lot more prompting rather than like just doing all the stuff based on, you know, fundamental core knowledge. So I think a lot of tasks are being simplified, and because of that, the companies are like, hey, well, if I can get the same output with one person, why do I have to have the other two that are just basically occupying space? And in 2022, it was an okay thing. You know, 2023, people started to realize how crazy this was. And now it's like on another level. I think one of our comments over there is putting it by Ikachi Griffith about co-pilots. It's nuts for productivity. So I think, you know, it's a very interesting thing that people are going to be discovering over the next 3 to 5 years. And a lot of the skills that even 3-4 years ago were in a ton of demand, we might see some softening because of just how much more efficient it is to use a lot of these tools to basically make yourselves more efficient. So, no.
Yeah, I mean, I noticed that it used to be a lot for me to kind of culminate data and polish data and get it kind of manager ready, or at least get the answers, and a lot, I guess, prepare for future answers that people are going to be asking questions for. And now with like utilizing something like a Foundry, I mean, it's not perfect, but having that data organized in a very routine structure globally across all of our different disparate data sets really allows and cuts down the workforce, you know, or sorry, the work needed to kind of be in preparation for that, because you know exactly where you need to go, you know exactly how to find it, you know exactly how it's going to be structured, and you know the nomenclature in order how to get it. So when things like AIP come around, which I guess is kind of like Copilot, kind of, but it's kind of our prompt system that's going to be layered on it. But I think we're going to try Copilot first. I don't know what's going to end up happening, but when things like that happen, I mean, the productivity is going to even increase even more so from what I've seen. And this is you know, just over the past 6 years through using something like a Palantir Foundry. So I can understand where and how people can truly harness that. And I think a lot of companies have yet to truly lean into that. Some companies have, but I think some companies have yet to truly lean into the use of AI products. I think, you know, UDoc, I don't want to speak too much on it, but I think that there's some companies like UDoc that are kind of playing, you know, which one is the best one to utilize and are being a little bit more cautious. But I think at the end of the day, you'll see, I think, a huge step change in efficiency, and whether that means good bottom line profits for people, of course, but that's obviously going to mean layoffs for a lot of different people as well. But I was actually curious. One of the things that I saw was Brian Monahan, who's the CEO of BofA, which is Bank of America. He was, and I'm curious about this piece because commercial real estate, this kind of coincides with it. A lot of people are kind of doing hot desking now, and this model of like hoteling where somebody might be using that desk Monday, Wednesday, Friday. Somebody else might be using a different desk Tuesday, Thursday. And so you can utilize 2 employees on one desk throughout the entirety of the week. So it's cutting down on the total occupancy for larger buildings. My question to you, Kris, is, and kind of going to what Brian said, he said that their commercial real estate portfolio on a big bank perspective has cut down substantially. I think they're using, there's 2 numbers. They're pretty similar actually. They're basically from $100 billion of commercial real estate down to like $30 billion of commercial real estate exposure to their portfolio. So a massive drop there. And then they're also talking about how they, in particular, went from 100 million square feet of usage of total office space to, I think, closer to 60 or 55 million square feet. So a 40% drop in their own commercial footprint. And I'm kind of curious to hear, like, do you see that a lot of other large large banks are following that trend, and really the only people that are exposed are smaller and more regional banks for commercial real estate? I know you've talked about this a bunch, but it kind of gets me thinking, if we're going to continue to see this layoff impact, where some chinks in the armor might be.
So this is where you have to be very specific in trying to determine what the class of the real estate portfolio that bank in particular has, right? So, if you look at a bank that has a lot of commercial class A real estate in big time cities, you're going to definitely see some valuation drops on the underlying buildings, but it's not going to be so significant that it really makes you like lose a ton of money. On the other hand, if your portfolio is full of suburban office space that, is like 50 years old, yeah, you might have some things to worry about because there is a tremendous amount of revaluation happening in the commercial real estate space. And also, you have to remember that the exposure to the banks is actually much more magnified than it is to like some of the commercial REITs that are out there. And the reason for that is because most of those loans are something called non-recourse, which means pretty much you as the lender will end up getting the keys back from the sponsor who owns the building. So, it's something to keep in mind. So I think a lot of banks right now, what they're doing is they are pretending and extending. Have you heard of that term before? No, you're muted. You're on mute.
They're kind of just bluffing, being like, oh, everything's fine. It's fine. It's fine. Until when they actually have to come up and they're like, oh, but if you just figure out a way that we can restructure this, is that what you're kind of saying? So
the best way I could describe it is this. Let's say you issued a loan 5 years ago to an office REIT. Everything was good. This is pre-pandemic. Occupancy was high. Everything is just humming along. Now, at the time you gave, let's say 3.5%, 4% interest rate, which was comfortable for you according to your risk adjusted models, right? Now, what happens, or even 5 or 7%, whatever the rates that you issued that out. What happens now, 5 years later, that loan has come up for refinancing? The sponsor is going to come to you and say, hey, listen, I can't afford the higher interest rate, right? So can you extend out the current interest rate that I have, which is a lot more favorable terms that was issued 5 years ago? And then at that point, you as the bank have to say, well, listen, I could just take that money and redeploy it elsewhere. So I want my money back. Now, the guys, they can't give you your money back because it's locked away in the building itself. So a lot of times they'll just say, okay, here's the keys. Enjoy. Here's put it into receivership. And now you would have to try to get your money back. Now, how do you do that? Well, you could sell it. The thing is, in this current market, you'll be lucky to get 50 cents on the dollar for your money. So now what happens is you're kind of like screwed if you do that. So if you try to sell it, you may sell it, but it may be at 50% loss, which means now you have to record that on your balance sheet as a giant loss. Yeah. And now imagine you have huge portfolio of buildings that are like this. You'll end up having to absorb all of those losses, which is not good. It'll actually
instead they give them favorable terms and extend on the current person.
Yeah, exactly. They'll just say, well, you know what? We can run the risk of letting the sponsor basically get another 5 years or whatever the term is that they privately negotiate, so that this way there's two things that can happen. One, they'll still be collecting the interest rate that they've been getting. Sure, they'll end up losing money, technically speaking, on paper, because if right now you could lend new money out at 8% and you're only getting 4% on an old loan, you're basically losing the opportunity of 4%. So yes, you will definitely take some possible profitability hits, but you also won't have a giant write down either. So, this is where you have to really dig down deep into each regional bank and see what kind of exposure they have to what kind of buildings, where are the buildings located? Are they in an area that you're going to see recovery in terms of occupancy, and how long is it going to be for occupancy to come back? In my opinion, we're at a point where commercial real estate is not being built a lot, primarily because you can't get financing for it, So what you're seeing is a lot of future space that could come online is being scaled back, which means that now the office space that you have will become more valuable over time, naturally, just from limited future supply. Because remember, you're still always going to need more and newer office space. That's just part of how the unit economics works. So you're going to have these Class C and B buildings that are old buildings. They will naturally, over time, be either demolished or converted into housing, or or repurposed for something else, and that will limit office space, which means that the buildings that are still around will end up appreciating over time. So a lot of this is actually very cyclical. So it's not like office real estate doesn't have its own cycles. They're just a lot more elongated than people think. So a lot of times people won't notice them nearly as much, but it's happened. You'll have these moments where there's just a lot of overbuilding and then a lot of underbuilding, and then it just goes back into overbuilding again. So this market dynamic is here to stay. So it's not something that I would worry about. So I'd say the biggest thing that we as investors have to keep an eye on when it comes to commercial real estate is just looking at the concentration of Class B and Class C real estate in either the commercial REIT segments or the regional banks, which are the primary go-to lenders for a lot of these guys. And there's also the CMBS market where you have to keep an eye on as well. So there's a lot of factors to keep an eye on, but I would say there are a lot of great opportunities in both the regional bank side and in the commercial REIT side, where you do have sponsors and REITs that have really high quality buildings that are starting to see a lot more people returning to the office. I think a lot of companies are also kind of discovering that full remote is not in their wheelhouse. At best, they could do maybe, a hybrid schedule, but I don't think that we're ever going to get away from a 100% fully remote thing. I don't see it happening. And I don't also see us going back to 100% come back to the office either. I think there's going to be a little bit more flexibility here and there for most workers. I think it's going to be an organizational decision on, how much office time you want, because it's just how things are,
Yeah. No, I agree with you 100%. I think the thing that I've observed personally is a lot of hybrid models in the oil and gas industry, and a lot of people specifically wanting to kind of do that instead of either fully remote. I think initially people were kind of saying, yeah, we can manage the fully remote thing. And after some time, I think that they recognize that productivity and being able to keep accountability for people just wasn't up to snuff. And so I think with that, they wanted to ensure that they were able to really get people on the hook. But what I did want to do is shut down Twitter and the Twitch live stream. So if you guys are watching on that, be sure to bring us onto YouTube, and so that way we can get your comments and stuff on YouTube. So I'm going to shut those down and have the conversation there. But Kris, I wanted to also talk about the portfolio, because we've trimmed a few things over the past week or so. Not a lot, but we have done a little bit. So just let me know if you can see the screen share in the portfolio. Yes, no?
No, I see it.
Cool. So yeah, we're still up 6% on the money. We deposited about $300 at the beginning of the month, $350. So we still have a decent amount in cash. So that's always good to have a little bit of cash. So we're about a quarter in cash at the moment. And I agree with you, Kris. I think just with where we're at and needing to kind of see a little bit, I don't mind holding a little bit more cash because everything I'm seeing at the moment, you're seeing some of our positions kind of come back down to reality. Rocket Lab being one is one of my favorites, and then Bros is coming down a little bit as well. So if these continue to kind of come down 5-10% additional, those are the ones I'm going to probably, for me, attack a little bit. But I know that Verizon's been holding in strong. It's still having a little bit of resistance to the $40 mark. So I'm hoping that turns around for you. And then I know that last week we had sold HCP and Extreme Networks. So I think there's still a little bit more fire to burn in those areas, and it might be too early to kind of enter those markets. But I think we bought. Can you remind me? Was it more BPYPM or was it more TELZ that we bought?
I think we might have bought more BPYPM.
Yeah.
You know?
Yeah.
Yeah, I agree with you on that. I think right now is just, we've got a good cash position. Let's wait. We can wait a little bit. There's sometimes it's not a good idea to wait because the cash is pretty much just burning a hole in your pocket, but that's not the case this time around. Right now, you can actually get a decent 5.5% return without having to really do much, So right now, I'm glad we have a good cash position. I'm hoping that we keep building that cash position until probably the next couple of months, actually. And then when things get really oversold, we can start deploying. I am doing some due diligence on Alibaba right now. I think Alibaba could possibly be a recovery stock, but like I said, it's a lot more driven by policy than by fundamentals, because the fundamentals for Alibaba are great. Like the numbers look absolutely terrific. The problem
they have
is
for a while too. That's the problem.
Yeah. And the problem is more on the policy side. So, a lot of commentary by Xi Jinping, a lot of commentary by the Chinese Politburo. I'm going to be really digging deep into those news reports and seeing what kind of structural changes are being made in the Chinese segment, because there could be an opportunity for a nice recovery play. But I do think that the market right now is starting to wake up to the idea that we might not get March rate cuts. And so a lot of those people who factored that into their investment thesis are kind of backtracking a little bit. And so, we'll see what happens. The other thing I'd say is a good idea to keep an eye on for us is possibly, some of the what is that thing called? Magnificent Seven. In particular, I'd say Amazon. You saw my last Patreon post.
Damn it, Kris! I was gonna give people a shout out. Kris did a great job, kind of looking at why one of the companies is doing so well, and I was gonna say, you gotta subscribe to it. But wait, you're not doing any more people, or you still have a little bit of more room for your Patreon?
I let it. There's a few people that dropped recently because I haven't posted much because I was sick. So just leaving it open for now.
Okay.
Yeah.
Cool. So if you guys are interested in seeing Kris's due diligence on that, be sure to look at Kris's Patreon. I always get some good insights from it. And the Discord, I think, is a good mixture of people asking really good questions about curiosity. So people kind of more in their infancy in terms of learning how to invest and just understanding and getting familiar with the financials piece. And then also people that are more advanced, sharing their stories, sharing where they're succeeding, sharing, their successes and their trades. And it's a huge culmination of a lot of different people, like specifically, people asking about selling puts and covered calls and stuff of the like. But I know I utilize selling covered calls a lot in my strategy. Not really to generate income, but just to get another 1 or 2%. I know a lot of people sell like TJ, and this is no hit on TJ. This is just different styles, right? He'll sell way closer to the money, and really try to get that wheel going. And I'm more of a person that just likes to hold the stock and equity positions for the long term, and just siphon off 1 or 2% per year. So it's not really looking for me to get 1% or 2% a month. Like I know some people, they try to, or not 1 or 2% a month, 1 or 2% a week. I know some people try to get they aim for 5% by selling covered calls and selling cash secured puts. And I'm just like, to me, I'm just not trying to chase 5% a month or anything like that. To me, I'm looking for more finding good companies long term. And if I see a good opportunity, I will. I'm not selling cash secured puts up here because, to me, the market, I still think, has a long way to kind of pull back before I would even entertain selling any sort of cash secured puts. But there are some companies like Rocket Lab, for example, which I'm trying to establish a very significant position. I have 25 contracts for Rocket Lab at $5 that I'll either let expire in the money and put those shares, or I'll just keep rolling them month after month to generate a little bit more income. But to me, it was like I think it was like 25 or 30 cents or something for a month. So it was almost like 5 or 6% on my money in a month. And I was like, I'd probably be buying another 2,500 shares below $5 anyway. So it just didn't make sense for me to not write that contract. But for the SPY, it doesn't make sense to be selling 450s or 460s on the SPY for cash secured puts. Like, it's just, to me, I think the market has some time to pull back before I entertain something like that.
Yeah, I mean, I have a list of companies that I track because they're like, some of them are really meme stockish. So the thing is, like, they're my they're my canaries in the coal mine. So whenever I see them kind of like going in the negative or the opposite direction, I start to see where we are in terms of like speculation, right? So speculation is what you kind of want to see, and well, you kind of want to don't see speculation, because that tells you that the market is either risk on and how you should approach the situation and like what kind of areas to look. So I'd say over the next couple of years, we've seen a lot of people really jump into growth, but I think growth may be taking a back burner to value going forward. So I think a lot of times, we've been on this growth train. So now it's time to look for value, companies that have strong, durable cash flows that can take that money, reinvest it into their business, or issue really good dividends, or do both, or even do stock buyback. So I think we're in a position right now where we have to look at these companies and say, okay, what is the real value of this company? And is it just all growth with sacrificing profitability, or is it a sustainable business model? And I think the ones that have a sustainable business model will outperform the market, and the ones that are more just, hey, we need to grow at all costs, I think those are the ones that are going to take a bigger hit.
I don't fully disagree with you, but I want to tweak it a little bit. So for me personally, right? So my thought process is 2023 was very easy. A lot of these companies coming off of 2022 were 60, 70, sometimes up to 90% down. So being able to invest in something like Open or some of the C3 AI, these companies that don't actually generate a profit yet, was very easy because they had to revert somewhat back to the mean, and they're still not making any profit, right? So you're going to have some of those companies that are out off of 2023 are going to take a large hit, right? So you were able to make a good amount of money. Some of them returned 100, 200, 300%. And they're going to give some of that back. Are they going to go back down to where they were back in the 2022 timeframe? I don't know. But it's not to say that all of those companies will. Like, the companies that have established themselves as actually making profits have come a long way over the past 18 to 24 months. Those might have more staying power. But I agree with Kris with respect to, we've let the other 493 stocks within the S&P 500 lag behind, and it's an opportunity for them to come back. There's too many stocks that offer so much value that are trading below a PE of 12, 13, 14, and it doesn't make sense because they're still growing at a pretty decent pace. So there are some out there, and I don't want people to get caught off guard, because if people start talking about value, they might jump into something like a Ford. They might jump into something like a GM, which is trading at single-digit PEs. You have to recognize there's a difference between a company that's in a very cyclical business and non-cyclical business. And when you look at the value stocks and you look at something that's trading at a 12 PE, you have to look at how their revenues kind of come. Like something like a Ford or GM, their revenues are very cyclical and are very dependent upon the business cycle. So things like that might show that, yes, it's trading at a single digit PE. It should go to 15, but at the same time, it's trading like that because their revenue might drop in half in the matter of a couple quarters, right? So you really have to understand some of those things and not get scared, right? It's the same thing with dividend yields. People might run and be like, oh my God, this thing has a 7-8% dividend yield. It's like, well, the stock just dropped like a rock and they're probably going to cut the dividend. And that's probably why. So you have to always be cautious. If something seems too good to be true, do your due diligence, like don't just take it for what it's worth. And that comes with 10 years of experience and me recognizing and making those mistakes myself, right? Seeing something that's trading at a 8-9% dividend, or in the case of Lynn Energy, when I first started investing in 2012, a 13% dividend. I was like, this will never go bankrupt, right? And then next thing you know, I'm not getting that dividend anymore, and I don't even know what happened with that stock. I don't know if I sold it or or what. But yeah, you just kind of have to think a little bit when it comes to some of those opportunities, and don't just sit on your laurels and just assume that just because it says 8%, it's going to be 8% forever. Look at Medical Properties Trust. Look at how even SLG had to trim its dividend a little bit. So some of these things aren't for granted, right? And it might depend on, you have to think, sometimes you have to cut off a pinky to save the whole arm or save the whole body. You cut the pinky off to be able to save 5-10% cash flow. And next thing you know, the company's back in good financial standing, is able to grow like they were previously. They just might have got a little over bloated in their share-based compensation. They might have got a little bloated on their dividend growth over the past 10 years, and having to sustain that. Part of the reason why people love these dividends is, generally speaking, when the board pronounces that, they say, okay, we have $5 billion a year for dividends. It's like, well, you're kind of promising that $5 billion in perpetuity. Otherwise, your stock's going to take a hit if you cut it, right? So anyway, a little bit of a tangent there, but just be cautious. And I agree with Kris. The value piece is something I'm on the lookout for. And I've seen a lot of great companies start to come to the top that have kind of been just steady runners over the past 5 to 10 years, that have kind of been neglected because the Magnificent Seven has just been on an absolute tear with the zero interest rate policies. So, yeah.
Yeah, there's a lot of value that's out there in the small and mid cap space that, if you the difference is you have to really dig down deep and look at that. The reason why I say that is because, a lot of people think there's value in small caps, but I'm not a big fan of the small cap indexes, primarily because there's about 40% of the companies in there are zombie companies, which can really mask strong companies that are in the small and mid cap space. So just keep an eye on that portion. For every every 2 good companies, I think there's a zombie company in there that's basically just existing. That doesn't have any real cash flow. I mean, it does have cash flows, but most of it's getting burned away. It's not a sustainable business model that they have. And it's just some of those things that you just have to, you really have to piece through. You really have to piece through a company's details in the small cap space. I think with large caps, these are the most, 500 of the biggest companies in the country. So you can safely say that they probably have some value there, and they'll continue to have value. In the small cap space, you're still on the more speculative side of things. So you have to be a little bit more cautious. So I think a lot of what we're seeing, like Tom Lee is very bullish on the small cap space. Let me actually just pull up the video on that.
Yeah.
Yeah. But
when was this? A couple days ago, or?
I think today. Let me see.
Was it? Okay. I love Tom.
Yeah.
I know he talked about it like a week or two ago, talking about how he was kind of bullish on the Russell 2000 and how he think it's going to return 50%. I wasn't sure if it was Russell 2000 or if it was the S&P 600.
He's actually calling for a short-term drop, actually. So let's take a look at that. So I can see that.
Skips. One of the biggest bulls on Wall Street, Fundstrat's Tom Lee. And I should have said that because you think the first part of this year, despite being bullish for the whole year, could be a little bit skimpy in terms of return.
Yes, Brian. I think we've got to digest that huge move you talked about.
Where's Tom Lee and what have you done with him?
This is the same thing I posted on the Patreon. I've been posting for the last 2 weeks. Did you notice that? Have you been reading it? About how the overall I'm bullish in 2024, but the first
he's now taking a stance. Yeah, because 2-3 weeks ago he was like, I don't know if we're gonna have a bullish early first half and it's gonna be flat the second half, or it's gonna be bullish in the first and then down in the middle and then up at the end, or what. So I'm glad to see that he's kind of taking a stance. Because to me, I kind of agree with it, because I've always kind of veered on that side of probably be kind of a pullback now and then get everybody shaking out for the rest of the year.
You were Mr. Bull last year. You were right on the mark about everything, and now you're a little more cautious.
Yeah, maybe it's because I skimped on the appetizers.
That's it. That's later.
Yes. Yeah, I'm still optimistic for the year. But, in the first half, and we got a glimpse of that today with Fed governors talking about not sure how many cuts they want to do. That's going to make markets nervous. And we got a pretty lousy Empire survey reading today, a regional PMI. and that's going to get people worried about a soft landing or hard landing. Those don't get answered for the next 6 months. So I think it's possible that we make a minor new high before the end of the month, and then we might have something like a 7% drawdown.
The Fed governor you're referring to is a gentleman named Christopher Waller, very smart guy, but he's not Jerome Powell. He is not the chair of the Federal Reserve. With all due respect to Mr. Waller, why is Wall Street suddenly paying so much attention to these one or two couple comments?
It's a fair question. We know for the last 2 years the Fed's been fighting inflation, so we know what that.
Before he continues, he'll give every reason under the sun, but I'll be very candid and just say exactly what it is. The expectations of a March rate cut got way, way too ahead of itself. That's it. The market just got overly bullish in December. And that's where the time was to just say, you know what, let's take a step back. So many companies had bull runs. It made no sense because the fundamentals had not improved yet. And so when we saw this hot December read come through, people are waking up and saying, hey, wait a second, maybe this March rate cut isn't going to happen. May rate cut might not even happen. We might end up getting a rate cut in June, which was not in a lot of people's calculations. So I think the market is just digesting.
It's pretty crazy, Chris. It went from like, with how things were kind of going, starting in the middle of last year, 2022, like the June, July timeframe, when things started to get very hyped up, people were like, okay, we might have a cut towards the end of the year, right? Which is why things kind of spiked up. If you remember, in the middle of 2022, they were like, everything's done. We're going to hold here. And people are like, oh my God, is there going to be a cut before the end of 2023? And then it went to, no, probably not. And then people all of a sudden, like the end of October, November timeframe, it went from basically, yes, there's going to be a couple cuts next year. We're feeling pretty good about that, to cuts are starting in March, and there's going to be 6 or 7 cuts. And I like the whole time I was just like, hold on, like this whole, like it almost got blown out of proportion so quickly that I was always very skeptical that there'd be some reversion to the mean. And I don't know if it was because of always having good grounded conversations with you about, hey, we're not out of the woods as of yet. But it just like, it's kind of interesting to like literally see this happening in real time, where the market just kind of went way overblown. And now it's kind of like pulling back a little bit, but I still feel like it hasn't pulled back enough, which I guess is what Tom's talking about here, to really justify, I guess, getting to the point where there's the next leg up. But anyway, I'll hit it back to you where the video.
That kind of regime and playbook is. Now we're moving to a playbook of, well, inflation is slowing. The Fed wants to keep real rates from getting too high, but we don't know what kind of cuts and when those happen. That's the nervousness we're going to have over the next 6 months.
I don't like to place too much credence in 1 month of data, particularly among some of these sort of smaller or more regional Fed surveys or surveys of this or surveys of that. You referenced one, though. This is the Empire Manufacturing Survey, folks. If you don't know what we're talking about, don't worry. 95% of you probably don't. It is a manufacturing survey around New York State. And usually it gets completely ignored by Wall Street. Nobody cares, except this data point, correct me if I'm wrong, Tom, came in so awful that even people who didn't care about this Empire survey suddenly started to care.
Yeah, it was pretty atrocious.
It was awful. But you think it's just one noisy data piece?
There's a lot of things that can make it noisy. We know supply chains are being rerouted right now, and we know markets have been tumultuous. And, we've seen that during weeks of market corrections, regional surveys often tank because the purchasing manager might just say things are worse, but it's because the stock market's down. So it's really hard to know how much is signal versus other things contributing to it.
But
just bring up the data real quick so we can take a look. This is what Tom Lee is and they're talking about right here. This is the Empire State Manufacturing Survey, and basically it's just a survey on to see where we are in the economic cycle, what's going on. So you see this precipitous drop in business conditions. This is not good. That means that when you have this huge drop, that means that everyone is feeling kind of like on the negative side. So when you're, let's say, CEO if you feel that next year you're going to have a tougher time, you're not going to order as many things. And if you don't order as many things, then the manufacturer doesn't produce as many things, and the manufacturer has to do layoffs. And then if they have to do layoffs, then those consumers are not going to be buying things, which kind of perpetuates a cycle that pushes us into more of a recessionary trend. So you can see here that last month we had huge reduction in this Empire survey. So you can see here unfilled orders, delivery times, inventory. It's just not a good report. Like, it's really bad. So, looking forward, there's a lot of positivity, but for now, it's not looking good.
So the data in the short term over the past several months has kind of started to show kind of deterioration to an extent of like, I don't know. I guess we're kind of stuck between a rock and a hard place, right? Where it's like you're seeing inflation data kind of not come down as quickly as it was over the past 6 months. A lot of that being driven by oil price and a lot of other things that were very easy to flush out of the system. But now you're starting to see, macroeconomic trends for businesses start to weaken. And then you're also starting to see these, layoffs starting to occur. And so my question is like, when you're the Fed sitting in between this, when you have to go to the meeting at the end of January, and talk about this on Wednesday, January 31st to the people, what do you highlight first? Like, are you sitting there saying, okay, we need to get inflation down, 2% means 2%? Or are you sitting there saying, which has kind of been the MO over the past, year or so, 2% means 2%? Or are you going back and saying, well, we're starting to see some rocky economic, from an unemployment perspective, and several other pieces are starting to look pretty shaky. Maybe we should still err on the caution, and a March hike is still up for grabs? Or do you think that this March is completely overblown at this point, and people need to get off their high horses and just say, okay, reset? It might be at earliest a May or a June cut.
I think March is completely off the table. Like, it's just
like
completely
100%.
To
Like,
me,
not
it's
even
100%. I don't even think it was on the table to begin with, to be fair with you.
I never did.
think
I never did either. I left a glimpse of hope of like 15 to 20, maybe 25%, because I think the people talking and everything got me kind of like excited. Like, maybe I'm the dumb one, right? Kind of like before rate hikes even started happening, I was like, maybe we'll get to like a 3.5% terminal rate. Like, this is before any rate hikes started happening. I was like, probably sounds like where we're going to go to. And the next thing you know, they just started ripping the curve. I'm surprised. Did you always think 0%, or did you think 5-10% for March?
I didn't think March. I think that was too early. It was too premature for that. The data didn't point to it. So, when the Fed said 2, I was like, okay, I'm pretty sold on the idea of 2. But yeah, I think the economic conditions are starting to weaken. So, I mean, that gives the Fed cover in June, but it doesn't give them cover in March. I think March is still too soon. So we'll see what happens. But overall, I think we are headed for, and I agree with Tom Lee, some pullback on the markets, where I think people are waking up. So this is where, if you were asking me, Chris, how would you position your portfolio? I'd say, number one, stay in high quality companies that are generating good cash flows, durable cash flows, that they can utilize this time of weakness to do a lot of capital engineering, right? So they can reduce down headcount. They can, buy back shares at an attractive price. These are the kinds of companies that will not lose money, and if anything, will help you gain some money, right? So if you are willing to be in the market, be in the market with good companies, have strong, durable cash flows, and that's number one. And number two, stockpile cash. Right, you're getting paid 5.5% on your money just to chill. So
you still have some time.
Don't go bottom feeding for companies. Like, I think so many people, they always have this, like, it feels like this burning hole in their pocket when they have money in it. And I'm just like, why? Like, you have the best thing possible. You've got cash, and your cash is generating return. Just chill.
Yeah.
Wait
One of
for the opportunity.
one of the best things that Warren Buffett always said: if you had 10 strikes and you got unlimited, you got 10 swings, he said, and you had limited pitches, and you just had those 10 swings, he's like, I guarantee you'd probably be a millionaire, because you'd be so focused on your due diligence and being able to make sure that you make the right decision. He's like, right now, people have as many opportunities as they want. And so it's almost like they can just throw money wherever they want. They don't have to be doing super high quality DD, because it's so easy to get in and out of the market that they don't do enough of it. So I thought that was pretty interesting. Kris, curious, do you have anything, other thoughts, or do you want to move into kind of chat Q&A? I saw a few questions there.
Yeah, let's do some Q&A. Let's do Q&A.
Okay. So first and foremost, I saw one in particular about PayPal. I know that I don't think that you were. What's your take on PayPal? I don't necessarily know where you stand.
PayPal has still got some room ahead of it to prove itself to be a recovery play. They've changed up their leadership. They're in building mode right now. So, you have to give leadership time. I think sometimes people, they think that when new people come in, it's an automatic V-shaped recovery. And unfortunately, that's not usually how it works. Usually with regards to PayPal and things like that, it'll be interesting to see the next earnings to see like what kind of changes they're projecting out and what they're likely to make, and then how far that's going to take their stock in the future. So you kind of want to see what their business is doing, how it's going to organize its capital resources. Are they planning on expanding in certain areas? Are they planning on pulling back in certain areas? So management right now, even though they sound very bullish, you got to give them time to kind of actually perform. So with PayPal, it's a watch and see kind of situation.
So to me, I wish everyone in PayPal well. I think that I believe that there's likely a possibility that it can turn around, but I'm more along the lines of you. If I do jump in, it would require me to actually see some results. I'm okay on missing 10-20% on a pop of say PayPal, if I know it's going in a better direction. Right now, I still feel like you could lose 10 to 20%, right? So you're kind of stuck in between this place where it's still uncertain. And to me, I'm with you. I'd rather wait until there's some certainty. But to me, it's one of those ones where it's like, I don't really see a long-term hold for me, so I'm probably out. But I think it's, for those people that are looking for that for a quick swing trade, if they make the right options play or whatever, I know Crossroads and many other folks are in it, and I wish them the best. But to me, it's just not one for me. Another one was Icon. I know you talked about it a little bit in the Discord yesterday. I used to be in Icon Enterprises back in 2015, 2016.
Well, I don't think I spoke about it. I just said that it wasn't something that interested me.
Okay.
It's just
I wasn't sure if you'd done any looking at the balance sheet or anything like that.
I very, very briefly looked at it a while ago. I actually took a very small position just as a swing trade, and then I got out. But they're fraught with a lot of like irregularities in how they do their compensation, and basically there's a lot more to IEP than what a lot of people are talking about. So I'd be very careful with that one. That's the one that I would not go yield chasing on.
Oh, Icon. That's been on a downtrend since I was investing in it. Yeah, I've been out of that one for quite some time. So one of the top performing stocks today, was it? Okay. Interesting. I know that a couple 2 months ago, Kris, you were kind of bullish on oil. I'm curious if your thought has changed a little bit. Where do you think prices are going to end up throughout the year? Let's just say in two scenarios. One, if there happens to be further escalation, and one, if there is, let's just say, no further escalation of some sort of war in the Middle East. And then do you have any positions in your portfolio at the moment?
No. I think oil, we swung that really well. We got a nice 10% out of our positions on that. But overall, I think oil is going to be pretty stable. I mean, it's an election year. There's definitely a lot of things in the background, and I think the shale drillers are absolutely just in a really great place in terms of generating profits. So they found the happy medium between profitability and supply. And so right now, I think oil stays at $70 to $85 at the most, which means that there's not a lot of room for upside, in my opinion. So I would say right now is a good time to just kind of hang back. I think oil right now is stable at the current prices. There are some companies that are still going to be able to perform okay, but yeah, I wouldn't be in a lot of oil. And the one that surprises me is natural gas. Natural gas is actually down 3% today, even after this whole cold spell that we have, which typically doesn't happen. Usually you see natural gas prices at the spot level spike, but you know.
I personally, from an energy perspective, I see that there's a lot of opportunity here to pick up in maybe some of the renewable spaces. There's been a lot of M&A deals going on behind the scenes. A lot of people may or may not be kind of privy to some pretty sneaky stuff. A lot of private companies, believe it or not, that are investing in, and they had a really good conversation about United States infrastructure. They doubled last year the capacity of renewables within the United States last year, which I thought was pretty astonishing. Globally, we're about 500, say, gigawatts of capacity. There's a few companies. I actually wrote an article on Seeking Alpha that should be coming out in a couple of days. Just getting my cobwebs out, because obviously I've never written an article on Seeking Alpha, and so getting that feedback from them and going back and forth. And I think that should be released within the next few days, about Ørsted, which is a deep water wind producer that actually used to be an oil and gas company, Danish Oil and Gas. So the ticker actually is DNNGY, which stands for Dongi, which is Danish Oil and Gas. I think that one's going to be a good player in the long term. They're going to double their capacity between now and 2030, and I think that that's going to triple their EBITDA. So I think that right now their market cap's around 24 billion. I think it could go to 75 to 100 billion by the end of the decade. So as long as they're not throwing out a bunch of shares or anything like that and diluting the crap out of the stock, it should be a 2.5 to 3x over the few years. But I still also hold about 800 some, maybe almost close to 900 shares of Shell. And obviously I get share-based compensation, which I don't generally talk about too much on the channel. But of the non-share-based compensation, I have a lot of Shell. And a lot of that has to do with, I think that they're just the most prudent operator, and they generate, $60 billion of cash flow from operations, which is comparable to some of these big tech Magnificent Seven-like companies. It's not as much, but, on par. And with that, if they decide to really turn on the tap and truly take over the energy grid, I think that they would have a really good job doing it. And then also I have NextEra Energy as a play, and I picked up Ørsted and NextEra after huge impacts in 2023 to their share prices. And so I think I picked up those at a pretty good spot. And I think as rates get cut, I think that since they're very debt heavy companies, they'll probably open up and have a lot of growth in them, just based on the fact that I think they've been beaten down so much in 2023 and late 2022 with rate rises. There was another one that I saw somebody commented about, but I wasn't sure if you saw any others.
I think I thoughts on SLG and SMCI. Okay, so with SLG, there is still some upside left, plus you're getting a dividend, but it's not nearly the value play that it was when it was in the 20s. Like when it was in the 20s, yeah, it was deep value. Like it was a no-brainer at 20. Now it's a little bit more reasonable and at earth. So I'd say you have to be very, depends on your risk level. At 20, there was very little risk. Now you're taking on a little bit more risk with SLG. SMCI, I think, is at a point where it's in the same category where it's riding very high on all the AI investments a lot of companies are making, and SMCI providing the hardware that goes along with those chips. So for now, SMCI is doing okay, but I think the risk to the to the upside is a lot more. So I am not an investor as in SMCI anymore. I sold out of the
Yeah,
position.
you made a good profit and you got
Yeah.
out.
So I just want to let
really
you know
good profit.
they are in a low margin business. Okay. And so what happens is any headline that goes down, they're going to get hit. They're going to get hit hard. So just letting you know that there are even bigger competitors out there like HPE and Dell that are eventually going to catch up to them as well. But Supermicro is a very good company, but I would not want to risk being an SMCI going forward. I think there are other deep value plays out there that are worth taking a chance on rather than SMCI. So I think there's, like I said, for me, it's always about risk to reward. When things go super low, your risk becomes a lot less. And when things ride up, the faster it rides up and the higher it rides up, the more risk you're taking on, because that means that in the future, the valuation may not justify it. So just keep an eye on that. And I'm glad if you've been holding SLG and SMCI, you've done exceptionally well on both the dividend side, on the SLG side, and the capital appreciation. And SMCI, just the capital appreciation is just amazing. So
me and
I
just going to say, me and Hot Steve have been running cover calls, and luckily for me, my cover call, one of them was kind of getting a little scary. It's going to expire worthless at this point, so it'd be nice to be able to rewrite for February or March and not have that concern. But unless it pops again, which but I'm up over 100%. Much appreciated for finding that diamond in the rough, you and Hot Steve. And I cut you off, so please continue.
No, I just think there's more value out there right now that is more. It's you have to remember what the great thing about investing with value is that when things are low, you're de-risked a lot because there's not really much room for downside. On the other hand, if you buy something at a much higher price, that means you're taking on a lot more risk and you're hoping that the company performs. With SMCI, they were in a secular trend in a market that they were really just dominating, which is the AI hardware support space, which they were able to monetize. And now the valuation is a little bit more rich. So SMCI is not something that I would want to risk forward, especially the business model is very cyclical. So, so yeah, like I said, I'm not in SMCI anymore. SLG, I still do have a position, but it's mostly for the dividends, because at least I'm getting paid to hold it. Yeah, that's about it.
And then maybe we'll end on this one. Firstly, before I touch on the Palantir piece from Azure, I think the thing that I wanted to mention about oil and gas companies is you have to think about how they actually trade. So yes, they do correlate with oil price movements up and down, but their earnings also have a lag. So when you think about what the spot price is today, $71, that you're seeing on the screen, that's actually for February prices. So a lot of these companies are selling contracts that they've already kind of fulfilled, and those contracts are being fulfilled for January already. And by the time we get into the third or fourth week of January, you're going to be selling oil for March. Now, that's probably really confusing to you, but you have to think, like, it takes time for these things to be offloaded from, say, the deep water Gulf of Mexico to be put into storage and then moved. And you have to organize how all these barrels are being moved across the country. So when you think about it, like when we're doing sales and contracts, it's like, okay, when do you need these products by? You're looking for petroleum folks that are actually refining this stuff to say, okay, we need to buy this product. They're sourcing it now for delivery in February timeframe. And then once we get towards the later half of this month, the books for February close, they open up for, let's just say, the March timeframe. So you have to recognize that's how things kind of change. And so there's sometimes a lag effect where people don't necessarily understand that just because oil price goes down 5-10%, doesn't necessarily it's happening immediately. It could happen this quarter, next quarter, that you really have to kind of pay attention to. And so what you might realize is prices might come down a little bit when oil price drops in terms of stocks and stuff of the like, but it might take a quarter or two for that actually be realized on the earnings. So there's almost like a double effect that you really need to take into concentration when you're looking at oil companies and the commodities piece. And I think a lot of people sometimes get caught off guard by that. And then I want to move into this last question about Palantir, and maybe Kris, if you want to talk about ARM, you can. I think Palantir, I'm happy that it's kind of come back down to the $16 range. I think it's a little bit more realistic. I would love to see it get back to 14. I think 14 is a way better price for it, but it's way better of a price down here in the low to mid 30s market cap than it was up to the $40-45 billion market cap. It didn't make sense up there. I still think that there needs to be some proven growth and reacceleration of growth in the product before you start seeing it trade in the $40-45 billion market cap range. So that's me personally, Chris. I don't know if you want to touch on Palantir or if you just want to move to ARM, and then we can close it out.
Yeah, ARM has got a lot of great IP, but I wouldn't buy much of it right now. The valuation is just too rich. It's curious. I am looking into AMD because there's a lot of positive commentary on AMD and like some of the AI chips that they could possibly come out with. And I think a lot of people are upgrading their price targets on AMD. So it's not something that I'm buying, but I'm taking a quick look at, I think
you and I were probably, what were you doing it today, Chris? Were you doing a quick look? We probably had the same thought. Probably watching the same video. And I was like, let me look at the spreads really quick about what we can do. So we might have to have a conversation offline about that one.
Yep.
Cool. Any other thoughts?
No, that's about it. I haven't really looked into Palantir much lately. Just the valuation. I'm hoping that it gets back down to 12 again. I think it has. I think it can. Especially if the earnings don't really fall in line with what everyone thinks. If it gets back into 12, I may end up buying a little bit here and there just to get the exposure and then go from there. I think Palantir is quickly turning into like one of the best trading stocks that someone can buy. Same thing with SoFi, because there's just such a heavy retail footprint that like you can kind of like do some decent extrapolation on what the valuation should be versus what it is. And when you see all these people rushing in, just sell them either covered calls or just sell them the stock. Like that's what I did to Palantir a couple of times, and it's been a worthwhile investment to make. So I'm in this, and I did the same thing with SoFi, and I think I'm going to do it again. I think if SoFi drops to maybe 6, I'll probably buy some SoFi and sell some, and when it rides up, I'll probably end up just selling some covered calls, and letting it do its thing. I think, like I said, there's just so much bullishness around this company based on nothing that it's just buy it, hold it until the next bull market comes for this thing, which is usually every 90 days apparently, and then just sell it to them at an expensive price and then wait for it to pull back and just, rinse and repeat. Basically.
Yeah, I think it's both going to be very, very volatile for both SoFi and Palantir. I think, depending on I think a lot of people are expecting the moon, and the moon might not come, like you always say. What's the term you always say? You expect so, and then so. I'm going to make you say it.
My wife is telling me not to be nicer about it. No, I'll screw it. I don't care. I'll say it. When you're expecting Lizzo to show up, you might get a Nicki Minaj or come up. But if you're expecting Rihanna to show up and Lizzo shows up, then you're gonna get hurt. So I'd say right now the market is expecting a lot of Rihannas, and more than likely you're probably gonna see a couple of Lizzos here and there. So,
oh man. All right, so with that, we'll end it there. Chris, thank you as always for showing up. I'm really glad you're feeling a little bit better. Hopefully, the little R&R over the past week was a little bit helpful. And as always, it's good to have you and your perspective on the show. Looking forward to a great 2024 with you, brother.
Yep. Take care.
Cool. Thanks. Good.
Bye.